Hi, this is Nikita Burdick and welcome to part 2 of analyzing the market security charts. Last video, which is posted on my YouTube channel, discussed overall what are the red and green candlesticks, how to read them, and then went into the Western technical indicators that we look at when determining what the market may do for rate locking purposes. This video is going to discuss the Eastern technical indicators, which focus on the candlesticks and will really tell you the reversal points. The first pattern that we are going to talk about is the bullish engulfing pattern. This is the upside, meaning it will tell us when pricing will go higher. The bullish signal will occur after a downtrend, after the bears are winning. The bullish engulfing is a 2-day pattern. So let's take a look at an example. The first candle will typically be a red bearish candle, and you pay attention to the body and not the wicks for this pattern. The next day's candle will be a green candle, but the body will be completely engulfed by the previous day's red candle. This is telling us that the bears were initially in control and looks like they have control of the market. Then opening price will open below the previous day's low and price, and the bears are still winning. But then it starts to rally and gets high enough to completely engulf the bear candle, and the bulls now have control. Let's see how it looks on the chart. Now look at how strong that is. You see the big upswing that occurred. If you can see that the pattern is going to represent an uptrend, then you can lock the rate at a time where your client can gain all the upward momentum. Alright, so the bearish engulfing pattern is the exact opposite. You will see this after an uptrend. So same concept, the second day's red candle will completely engulf the green candle. Let's look at the chart. There was clearly an uptrend, then we have the bearish engulfing candle. What do you think happened? Well, you can see in the chart that the bulls have lost control and the bears have taken control, and we see a downtrend. The next indicator that I want to look at is the hammer. The hammer is going to have a long wick, usually at least 2 times the size of the body. The market is trying to find a bottom. This indicator is very helpful. It is a bullish signal because it is trying to show where there will be a bottom and then go higher, signifying an uptrend. There must be a downtrend first. So we actually recently had a hammer. So let's take a look at recently at September 19th. You will see the chart where is the market that we had a downtrend followed by a hammer. After that, we had a slight increase in the market before pricing decreased again. It was a short-lived increase in pricing, but you waited to lock, then you gained that days of pricing. We can see more pronounced one below. Alright, so next, let's look at the hanging man. This one comes at the end of an uptrend and looks very similar to a hammer. It will signify the opposite, that we are nearing a downtrend. Okay, so the hammer could also be a bullish inverted hammer. For a bullish inverted hammer, you will see the extra long extended wick above the body of the candle. It is still going to occur at the end of a downtrend. This is an inverted hammer, will also indicate a move up. Next, we have the bearish shooting star. A bearish shooting star looks like a hammer, but it is inverted and it happens after an uptrend. The bulls are in control and we see the inverted hammer. This is a shooting star and we should be seeing a pricing drop. When you see this, you will want to lock the rate in. You can see an example where by doing this over 4 weeks, you could save your client a ton of money. Alright, the next symbol is called the doji. A doji star symbolizes indecision. It means neither the bulls or the bears have control of the market. There is not much of a body on the candle because it opens and closes near or at the same exact price. This tells us that volatility is ahead. We do not know if the market will go up or down. All we know is that the market is going to be crazy and we need to pay attention to what happens next, because when it does start moving in a direction, it will take off. The next symbol to identify is called the morning star. The morning star is a 3-day pattern that occurs after a downtrend and signifies an uptrend. This pattern is a long red candle followed by a short body candle and end with a long green candle. The middle candle has to be a small candle and can even be a doji. You can count on a big move up after a morning star, so this is a powerful symbol to identify. The opposite is what we'll see with a bearish evening star. This occurs after an uptrend. You will see a green candle followed by indecision and then a red candle. This will symbolize that we are in for a downtrend.